believe it or not, it's the last day of the second quarter. We already arrived to the second half of what has been an intense year in the technology sector. The NASDAQ 100 is like modestly higher right now in the session, but we continue to push consecutive record highs. What is the single catalyst for tech right now, Angelo?
Yeah, as you said, certainly a lot has happened in the first half of the year. And maybe the fact that we are hitting all-time highs, we see that as a validation of the positive momentum, not an indication or a signal of an imminent correction. Certainly the decline, the de-risking in geopolitical trade tensions and other tensions has helped. But at the same time, really what is undisputed is the strength in corporate profits, especially within tech. We are hitting all-time highs, but it is the largest companies that are driving this. About 6% of the S&P 500 has been hitting new highs as of last Friday. So it hasn't yet been broad, but at the same time, that shouldn't really dilute the message that we remain in a bull market. Summer center is ahead, but corporate profits is what is driving this action.
Corporate profits that sees growth actually start to accelerate out of the US, Angelo. Going forward, the second half, is it going to be US exceptionalism? Or if we look at what Bloomberg Intelligence have just been writing, great piece of analysis coming out of Gina and her team today, saying the US is no longer setting the pace for global tech earnings. In fact, that's going to Asia and Europe. What do you make of it?
What is happening is the growth gap and the growth advantage that the US has had is narrowing, especially as we think about this year. Europe is accelerating from stagnation, while we are decelerating from a very strong starting point. But at the same time, looking at the major indices for international developed large cap equities, it's been a narrowing of the gap in valuations, which still remains large, rather than an earnings story. So if we see some stabilization in the US dollar in the second half, based on the earnings still outperformance from US equities, we would expect potentially US tech and US assets more broadly to come back into favor.
OK, any area in particular? We've been all about hardware for the last couple of years. Software got its moment in the sun, but I'm interested in the areas in particular that you like within the tech ecosystem of the US.
I think the equal weighted index is also one way to go and participate in that likely broadening that is happening. Yes, NVIDIA and semiconductors remain key at the center of these exciting secular tailwinds that are ahead. But we are seeing last week the equal weighted technology S&P make new highs relative to the market, and that is an encouraging development. So remain broadly diversified. Software still likely favored, but that is the case for many other sectors, and we can talk about that as well.
Well, Angelo, I kind of want to go back to the top news stories of the day, which largely center around trade, Canada and digital tax. We have heard, and we will hear again very shortly, from US Treasury Secretary Scott Bessent. But the reason I bring that up is that in summary of the prior quarter, it was really trade that was driving us. I asked this difficult question to every markets participant that comes on the show. What happens next, particularly in tech?
Yeah, trade in the near term is still going to be front and center. We have the trade deadline that is coming up July 9th. But that date has been de-risked a little bit. The administration has indicated that this could be extended. There's many potential agreements with major trading partners underway, and this can be unveiled over the coming days. But since the start of the year, we are seeing this expected and gradual pivot towards more market-friendly policies, tax cuts, deregulation. So there could be some near-term volatility and some potentially less friendly economic data that reflect a mildly stagflationary impact. But markets are going to be able to look through that as they focus on 2026.
Angelo, going back to the micro to finish, I talked about those two deals at the top. Palantir partnering with Accenture, sales channel, Oracle, $30 billion per year cloud client. Outside of those just being news stories that drive those single names higher, how much do you track those data sets for signals of how enduring an AI investment cycle is, or how real any of this is in the AI context?
These are important, and no doubt the cycle is real. We see that in broader adoption, and we see that in the results from the companies that are centered in this space. As we think about moving further away from the trade headwinds, that's going to be a next major step. Some confidence for more deals to happen. And I think that is something that can be supportive of the market and the tech space in general.